You're listening to Money Never Sleeps Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Greed, for lack of a better word, is good.
You know what I mean?
Money to be made in a place like this.
Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine when it hurts.
You know what it takes to sell real estate?
It takes brass.
I've fallen, and I can't get up.
All right, welcome to Money Never Sleeps. This is a show where we talk about anything and everything that impacts the flow of money from around the corner to around the world. And I want to thank you for joining me today. A lot of interesting things happening in the world, especially in the world of crypto and private credit markets. And I want to go into that on this show today because it deserves the attention. The Clarity Act. This is something that should have been passed already. All right, this basically defines the crypto landscape and what's happening. It's been delayed over and over again, and it's because of a couple of line items where, you have banks, traditional banks, they do not want for stable coins to have yield outside of the banks. Because if you, as a person that maybe you have savings or you have a CD with a bank that's getting 4 or 5%, and albeit regulated and safe and everything else, you do have regulated Coinbase and whatnot. But what if you have the option to go get 6-7% on your savings as opposed to getting locked into a CD, and you're able to do that but have liquidity? Okay, well, you're not locked into something for 6 months, 3 months, a year, 5 years. It changes the game. And for the banks, if that happens, which is happening, right? It's happening overseas. But it'll take away those assets under management for the bank. This is why I don't understand why banks don't just embrace it, because then they can be custodians. If you're a custodian of digital assets, it makes it easier for you because you can actually go offer yield and things like that. But the banks, they can't compete with the yield that is brought forward from the stable coins in the crypto space, because the players in that space, they know how to monetize it, and they go through that whole cycle of stuff. And that's where the change happens. Banks do banking, traditional banking stuff. The DeFi market, decentralized finance, the DeFi market, they do DeFi things. At some point, there's going to be a convergence, and I keep saying this, and there's pushing towards that. But the Clarity Act itself is being held back because of that. You can slice and dice it and have all senators say this, that, and the other thing, everything on the far left, have everyone say what they need to say. But and it's funny that when you're looking at the far left, they are supposed to be kind of leaning towards this freedom, right? This type of thing, and you would think that they would embrace DeFi, but no, they want to stifle it, I guess, because it starts moving power away where power belongs, and that's with the people. And I've always believed in that. Power to the people. This is why politics sometimes gets a little crazy. I'm not getting into that here, but I'm sticking to the topics that are at hand. So the Digital Asset Market Clarity Act, that's a core. That's the core of the U.S. market structure bill that they laid forward, right? It's aimed at drawing a durable line between what counts as a digital commodity, which is under the CFTC, and what counts as a digital security and investment contract under the SEC. None of this stuff has ever been an argument. Okay, it passed the House with really strong bipartisan support, but it remains stalled in the Senate, right? Where they need 60 votes to move it forward, and they're not getting it. All right, and there are a lot of reasons for this. As I said, you start losing control, and it's not there's no question about the commodity or security part of it. What it comes down to is how things are going to be dealt with. All right, if this passes, banks actually can start losing business because you'll have the Coinbase, the Robinhoods, of the world that'll provide yield for stable coins because they can, where the banks cannot because they choose not to support the system that can actually increase their business. It can make banks stronger and bigger and more viable. They choose not to. They're starting to do this in Europe, and I think more banks need to embrace it. Now, Congress, they're arguing over ethics provisions. The stable coin yields is the big thing, and the DeFi treatment. Regulators, basically they have to stop waiting on this. The SEC and the CFTC, they're ready to rock and roll. They issued joint guidance. They're coming together. They're classifying digital assets into the categories that they should be: digital commodities, stable coins, and digital securities. Effectively creating a map, a jurisdictional map by interpretation rather than statute. And right now that's a stopgap to the framework until the Clarity Act passes. And again, people think that it's going to pass by September. We may not see this pass till next year. Who knows? If it passes in September, it's all better for the industry. If not, then not. I know that you have Trump. President Trump is pushing for this to happen already. But he can only do so much. If it's held off at the Senate, it's held off at the Senate. Now you have midterms coming up and all this other stuff happening, and the power may shift. And if the Democrats start gaining seats, this Clarity Act may not pass until sometime next year, until things start changing. I don't know. Everything is up in the air. That's why they're trying to push it now while they have the ability to do so. Okay, and that's the reality of it. With Trump talking about this, what wound up happening, you had you had a few things going on, okay, where you had crypto, all right, from Bitcoin, Ethereum, Solana on down, had a run. I think in total you're looking probably about a 15-20% run on all these tokens. Okay, you're talking about double-digit more. I mean, low double-digit moves, and it's not only, and nothing dramatic happened, right? What transpired is that President Trump said something, and you've had organizations, firms, institutions, individuals, they're levered to the hilt on the short end of the stick. Now, when you have crypto and it starts moving in a positive manner, those shorts get dwindled, and you're talking about leverage of 10, 20, 30, 50 times. Now, as it moves higher, guess what? Whatever you have margin starts reducing. Now, if you are in a platform that has it, that you limit your liability because maybe you have a stop loss, you have something going on there, then it'll protect you. But what it does, it just continues to have an impact on things, because now, let's say if you're short and now you're in this case, and it's possible, you're forced to cover. Who are you getting it from? You have to go in the open market and buy and buy and buy and move it higher to the moon, as they say, to the moon. All right, so this is the stuff that you see that's going on right now, and it's good. It's a shake-up. The volatility in the crypto market is serious. It can stay calm like the ocean, but you get one little stone going in the water and it creates a ripple, then all of a sudden you have a typhoon, you have big monster waves that go on, and this is the nature of the crypto market. All right, you have a lot of things that are impacting the crypto markets as a whole. The Clarity Act is the big thing, because then that'll have a trickle effect globally. But in the crypto space, headline risks, uncertainty, Again, around the Clarity Act, that is a big thing. Stablecoin yield bands and jurisdiction splits from the SEC, CFTC, all this stuff. It creates volatility and risk-off positioning, and this is a fact. And as I mentioned, the leverage shorts, they're going to go back in, and that's the interesting part. When they go back in, should there some positive news come out, you're going to see the markets fly even higher. If nothing happens, then the shorts will win for the moment. But these short squeezes are pushed. Okay, and look, the net effect of all this is that regulation. I guarantee you, they even have this on Polymarket and Kalshi and everything. Regulation is now a tradable macro factor in the crypto space, and it kind of falls into the leverage positioning, especially with shorts. And any incremental policy news, anything, can provide a price shock, and we've been seeing that. You have the CFTC and SEC. They've been doing some things, right, while the Clarity Act is in flux. Okay, CFTC Chair Michael Selig, he's a great guy. I like what he's doing. And I think that more of this has to transpire. He's made it clear that the agency will move ahead even if the Clarity Act stalls, if it's stuck in all the red tape. If you're old enough to know about, when I was a kid, you had Channel 13 PBS, and you had the little Bill cartoon, explaining to you what the bill does and how it gets stalled on Capitol Hill. This is what we're facing right now. And he's directed staff to explore rules that allow leverage and margin crypto trading. Developer protections. Protect the developers, for Christ's sakes, protect them. They're the innovators of the space. And a broader market structure regime under existing authority. And this is what needs to happen. Now, in practice, what does it mean? It means that digital commodity spot markets, they can see more formal CFTC oversight even before Congress codifies it, even before then. Exchanges and trading venues, they'll get a clearer sense of how the CFTC views leverage, margin, and risk controls in the crypto markets. Big thing. You need to know what you're playing with, because other than that, you're throwing darts in the dark, and you're trying to hit the dartboard, and you don't even know what the dartboard is. And then when you throw the dart, you hit somebody in the head, then you're to blame because you're the bad guy, right? Because you're the person that did it. So clarity needs to be here, needs to happen. You have Senator Loomis has been pushing for this. So many people from Brian Armstrong on down have been pushing for this. It needs to happen. And the CFTC, they're taking a proactive stance that's meant to reduce regulatory uncertainty. It helps the market. And it signals that commodity-style crypto trading will have a defined rule book, with or without the Clarity Act. That's what he's saying. So we'll see where that goes. Now, the SEC, they're no slouches either. They're doing some things, and they're laying out some rules, and it becomes very interesting. They've already proposed regulation on crypto assets. Basically, they have a tailored regime for token offerings and capital raising under securities law, and it includes a conditional safe harbor, so certain tokens are not automatically treated as investment contracts. So just because you tokenize something doesn't mean it's a security. It's not an investment contract. You mean there has to be clarity around that. Some key elements of that is the fit-for-purpose framework for crypto capital raising. With the proper disclosure and ongoing reporting, this is what needs to happen. This is what they want to happen. And safe harbor windows and issuance caps. Big thing. Okay, it's going to limit the amount of tokens that can be issued over a certain amount of time, over defined periods. This allows for innovation while preserving investor protection. You don't want to have a token that has 1 million tokens and all of a sudden you invest in it, then the next month there are 10 million tokens. You just got reduced, right? Okay, you can't have things like that happen. So it's good that they kind of put things like that in play. It prevents the bad actors from going and doing things they shouldn't do. So having these guardrails is a good thing. Again, the Clarity Act came through, it would be more defined. Right now, they're doing workarounds because they have no choice. All right, the SEC, they're building a parallel regulatory track so crypto firms can raise capital and operate with clearer rules even before the Clarity Act becomes law. And again, the two organizations that are normally at each other's necks, well, what are they doing? They're working together to try to get things done, and that's the way it should be. More people, let's all get along. Let's all get along and let's get things done. The crypto market is the future of finance, and what I don't mean that it's going to take over. What I mean is that you will have a convergence of decentralized finance and traditional finance will come together, and we're going to have that space there. And we need some defined borders, for lack of a better phrase, so that organizations, whether it be a financial institution, private equity firm, hedge fund, developers, innovators, so on and so forth, exchanges, you need some sort of idea where that's going, right? You need it because the wild west of way back when doesn't need to exist now. We have too much technology at our fingertips to prevent it, right? So let's hope the Clarity Act passes. I have doubts that it's going to pass in September. I think that potentially we're looking at next year, but we will see. I have hope that it does pass in September, but my logic tells me no, right? So now we're going to kind of take a mosey on across the street to private credit markets. Okay, I want to go over that because that kind of is kind of pins into what I'm going over with the Clarity Act a little bit. You'll get it when I go over it. The private credit market has grown into a core alternative asset class. There's no question about it. It's driven by banks retreating from certain lending segments, and then that leaves an opening for private credit issuers to jump right in. And you have investors that are searching for yield. They're not looking for 2-3%. They're looking for higher, 4, 5, 6, 7, whatever percent. They want junk bond money. They want junk bond yields. All right, the market is now large. The market is now global. The market is now deeply institutional. But, believe it or not, it's still structurally imperfect. It kind of, if you want to get an idea, during the mid-2000s, you had all these mortgage-backed securities. Mortgage-backed security was a good idea until they started bundling the bundles and bundling the bundles of the bundle of the bundle and bundling that bundle and then going and having credit default swaps on everything. And yeah, so this is where this is the round that things are going to wind up, will wind up going on that road probably. In the private credit markets, opacity, that is the big thing. Documentation, valuation, and reporting is seriously fragmented and manager dependent. All right, so that means that it's hard for you to assess the cross portfolio risk. It makes it very difficult because how are you pricing it? How are you pricing that debt? How are you doing it? Okay, are you pricing it on a daily? Are you pricing it on a monthly? You're pricing it quarterly? What is it based on? And all this stuff is opaque. So you need some clarity there. Liquidity. Okay, loans when they're done, there's no cookie cutter mold like you have at a bank. Loans are bespoke. They're rarely traded and often locked for years with limited secondary markets. Even though you have secondary market players that are coming out trying to do some things, okay, it becomes very, very dark in the room. The regulatory patchwork, the oversight that it varies from jurisdiction to jurisdiction. And there's no unified global framework for private credit markets for any transparency or trading. And, well, that's where the pricing and everything comes in, because how do you price it? And these shortfalls are there. They're there and right in front of you. But the demand remains strong, and the reason being is that banks are making it difficult for a company to go and borrow. And this brings me back to the Milken days. This is why Michael Milken, he didn't invent the junk market. He basically made it evolve. He saw at the time that there was a big disconnect, that you had banks and institutions that were just funding companies that really, they had money, but they needed more money to do these things, but they were ignoring the companies that actually needed the money to go and do the things, make the acquisitions, do the things they needed to do. And this is where the private credit markets come in. This is where they come in. This is where they thrive. This is, the banks invented this. It's like, you can't, and when I say they invented it, they basically created the beast, meaning they left something open. Same way, in the late 70s and early 80s, where the junk bond market was there. Nobody paid attention to it. Nobody cared. They said it's garbage. That's why they call it junk. But it was high yield junk. But when Milken mapped it out, it was very simple and logical. And then you had some of the biggest LBOs in history that took place to this day. Okay, he changed financial markets forever. Private credit is changing financial markets right now as we speak. And if you think for a second that there's not going to be something further that's going on there, you're out of your mind if you think that. It's going to evolve, and I've been talking about this for some time. CDSs, tokenization, on-chain markets, all this stuff's going to happen. The direction of travel is towards standardization and digitization, and tokenization, actually. Okay? Credit default swaps on private credit. No, that's coming out, and it's already there. I think BlackRock or Goldman started doing it. They're not stupid. They have their fingers on the pulse of this market, and they're going to go run with it. Okay? As data improves and documentation becomes more standardized, you're going to have CDS-style hedging on private loans and portfolios. They're going to become more feasible. They're going to give institutions tools to manage credit risk dynamically, rather just than we're going to hold this to maturity because we don't know what is valued at, but we know at the end there's a certainty of what we're going to get. We hope, we pray. Okay, this gives them the ability to get liquidity, to monetize, to do different things. Tokenization of credit exposures. Woo, this is going to be a beauty. Loans, tranches, and portfolios, they can be presented as on-chain instruments. I've talked about digital credit note tokens for the longest time, something that FJA Partners actually pioneered. Also, private credit tokens, same premise, and giving transparency to the investment community. And the thing is, the great thing about these DCNs, these digital credit note tokens, they weren't created just for one firm. They were created for the whole, financial community. So if Goldman Sachs or Morgan Stanley or BlackRock wanted to go and create one of these for one of their deals, they can jump right in. Water's warm. Make it happen. And that's the hope of it all, right? Okay, so now with the tokenization, you can have, the programmable cash flows, real-time reporting, and composable risk transfer and the like. This basically aligns with the broader trends in tokenized treasuries, real-world assets, and digital securities. This is where things are going, and this is going to happen here. Now, it's going to make things a lot more transparent, and it's going to make things a lot more interesting. And you're going to have 24-hour global trading rails. And the crypto markets have this now. Decentralized markets have it now. Robinhood has it now. Coinbase has it now. You have, other organizations that have it now. All they need to do is list them. You're going to have continuous cross-border markets. So you can have, your debt here, your private credit here, your debt here in the United States, or your debt somewhere else in Europe, but all of a sudden you have someone in Zimbabwe that's looking for yield because they have a couple of bucks and they want the income, and they're buying it and they're getting it without having to jump through hoops. How do you like that? Wouldn't that be beautiful? It's going to be beautiful, and it's going to happen. So, when you put this all together, you get a future where private credit markets are no longer static and opaque. They're not just a book of loans that are in some foreign language. What you're going to get is a transparent, tradable, and hedgeable asset class. I say it now, and it's going to happen. With CDS, structured products, and tokenized instruments all operating on regulated, data-rich rails, and so on and so forth. Okay? All these things are going to transpire, I believe. Clarity Act, still on the fence of what's going to happen there. All I can tell you is this. If you are not a believer in the crypto markets or in tokenization, then you should change your tune. That's kind of like way back when you had the television that came out. Okay, can you believe at that time that people were saying, well, that's a fad. We like our radio. We're going to sit in front of the radio with the family and listen to the radio. Okay, TV is not going to last. Well, the only time you have a radio is in your car nowadays, right? Okay, and then I remember this like and I have the clipping of it. It was an article I think it was in the early 90s or something. And anyway, or the late 80s. What the title of the article is that the internet is a fad. Okay, it's not going anywhere. We can't live without it. I can't have this show without it. You can't trade without it. You can't do anything. The internet opened everything up. Blockchain is opening up they're opening up the lines and democratizing everything. And AI, it's going to open up that gap a little further. We're in for a wild ride. We're alive at the best moment, I believe, in the history of this country, of the world for that matter. We're going to be experiencing things and seeing things from the rise of humanoids and AI to the rise of blockchain and crypto assets, the convergence of traditional finance and decentralized finance, changing it forever, and all the other things are going to be in the history books. Take that to the bank. Anyway, I want to thank you for tuning in to Money Never Sleeps Radio. It's Friday. I want you guys to have a fantastic trading day. Have a great week, and just put some thought into what I talked about on this show. And, if you have questions, you can always, reach out. But other than that, really think about where the future of finance is going, because it's going to a fantastic place. These blockades from traditional outlets need to stop in order for this convergence to happen. And that's my view. So we'll see what happens in September with the Clarity Act. Okay, until then, I want you guys to have a fantastic trading day and have a fantastic weekend. We'll be back with you next week. Thank you.
Initiating shutdown sequence.
You're listening to UCW Radio. In your face.
What is your major malfunction?
So let it be written. So let it be done.
Ladies and gentlemen, my mother thanks you, my father thanks you, my sister thanks you, and I thank you.
The views and opinions expressed on Money Never Sleeps Radio are for informational purposes only and should not be construed as financial advice. The host Louis Velazquez and guests of Money Never Sleeps Radio are not licensed financial advisors, and any investment decisions made based on information presented in this podcast are at the listener's own risk. Listeners are encouraged to consult with a qualified financial advisor or investment professional before making any investment decisions. The podcast hosts and guests do not endorse or recommend any specific investment strategies or products. All investments involve risk, and past performance is not indicative of future results.